Hey guys, I just wanted to record a quick video on the Fed's recent statement about their September meeting and how it proves that I was right, which, on the internet is the most important thing, as we all know. So I'm just going to go through their actual prepared remarks real quick, and we're going to talk about a little bit about what that means for the upcoming term, like the next 6 months or so. So, what did they say? In about 500 plus words, they said, information received since the Federal Open Market Committee met in July suggests that economic activity is expanding at a moderate pace. Household spending and business fixed investment have been increasing moderately, and the housing sector has improved further. However, net exports have been soft. The labor market continues to improve with solid job gains, and declining unemployment. On balance, labor market indicators show that underutilization of labor resources has diminished since early this year. Inflation has continued to run below the committee's longer-run objective, partly reflecting declines in energy prices and in prices of non-energy imports. Market-based measures of inflation compensation moved lower. Survey-based measures of longer-term inflation expectations have remained stable. Consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. Recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. That's a very important sentence. Recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. Nonetheless, the committee expects that with appropriate policy accommodation, economic activity will expand at a moderate pace, with labor market indicators continuing to move toward levels the committee judges consistent with its dual mandate. The committee continues to see the risks to the outlook for economic activity and the labor market as nearly balanced, but is monitoring developments abroad. Inflation is anticipated to remain near its recent low level in the near term, but the committee expects inflation to rise gradually toward 2% over the medium term as the labor market improves further and the transitory effects of declines in energy and import prices dissipate. The committee continues to monitor inflation developments closely. To support continued progress toward maximum employment and price stability, the committee today reaffirmed its view that the current 0 to 1/4% target range for the federal funds rate remains appropriate. In determining how long to maintain this target range, the committee will assess progress, both realized and expected, towards its objectives of maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. There's that international thing again. The committee anticipates that it will be appropriate to raise the target range for the federal funds rate when it has seen some further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. The committee is maintaining its existing policy of reinvesting principal payments from its holdings of agency debt and agency mortgage-backed securities in agency mortgage-backed securities and of rolling over maturing treasury securities at auction. This policy, by keeping the committee's holdings of longer-term securities at sizable levels, should help maintain accommodative financial conditions. That's certainly true. When the committee decides to begin to remove policy accommodation, it will take a balanced approach consistent with its longer-run goals of maximum employment and inflation of 2%. The committee currently anticipates that even after employment and inflation are near mandate-consistent levels, economic conditions may, for some time, warrant keeping the target federal funds rate below the levels the committee views as normal in the longer run. Okay, so that's the statement. Notice a couple things. They mention that they're talking about international developments. So that's, we had the Chinese stock market coming way down over the last couple of months. Commodity prices have gone way down. And why is all this stuff happening? Is it just random? Well, China's case is a little unique in that they relaxed regulations, a bunch of people came into the market, and, so we had this, very quick boom bust going on. But the markets as a whole across the world, they've been selling off. Why have they been selling off? Well, it's because people thought the Fed was going to start raising rates. So there's this kind of cycle going on here where people think the Fed's going to raise rates, so they know that if they do that, the dollar will get stronger, everything else will get cheaper, and they're going to sell in front of that because, they don't want to get caught holding the bag. So they sell their stock in foreign markets or even in the U.S. market. We've had a lot of gyrations over the last few weeks. And then, okay, so stock prices come down, bonds come down, whatever else, commodity prices come down. And then the Fed points to that and they say, well, we can't raise rates because, everything's going down. So clearly we need to be further accommodative and, keep our rate at 0 or 0 to 1/4. So it's this kind of vicious cycle. And what they're saying here is that that's basically going to continue. Even if they do raise rates at some point in the future, then it's going to be, a very long protracted period of raising rates. It's not going to be like that quarter point every meeting that we saw under Greenspan. And then, they're saying that even if the so-called mandate targets are reached of 2% inflation and full employment, and those are kind of subject to interpretation, then the rates are going to remain below, what's normal for, basically the foreseeable future. So back when we had those 1,000-point, swings in the Dow, I published a blog post, and towards the end of it, I said essentially what is going on is that people are assuming the Federal Reserve is going to be raising interest rates in September, even though Janet Yellen has come out and said that if they do raise rate, it's going to be very small and going to take a long time. For whatever reason, people have interpreted this to mean that rates are going to go all the way up and dollars going to get stronger, and therefore prices must come down. So they want to get out while the getting's good. This is why stocks all across the world have been going down over the last little while. The silver lining for all those buy and hold investors out there is that the Fed can now use this as an excuse to not raise rates. In fact, I think they will use these events as an excuse to ramp up the printing presses again with another round of quantitative easing. Well, they haven't done that last part yet, but I think it will be coming at some point. But in a way, this is actually good news. So the Fed is pointing to all these market gyrations. They're saying, well, we can't raise rates. And once, even though the markets are actually down today, once the investors all across the world realize that the Fed's serious about not raising rates, and all this expectation in the media is just made up essentially, then they're going to start realizing that, oh, cheap money is here to stay, at least for a while. So, we're going to see stocks go back up. We're going to see money go into bonds. We're going to see money go into commodities. So, in the next 6 months, I would not be surprised at all if we actually see new highs in the stocks and the bond markets. However, there are problems appearing. So in the last bubble, the problem started with the subprime housing market, and now what we're seeing is problems in the subprime auto market, where they've been extending the length of terms of the auto loans, 6-7 years. We're seeing no down payment and even cash back with rewards and rebates and whatever. And even with that, the sales numbers and the inventories numbers are starting to head down. So this might be the place where the next pricking of the bubble occurs. We'll have to wait and see on that, but that's what it's looking like at the moment. So the short version is Fed is gonna keep money cheap. Because of that, stock markets, bond markets, commodities will eventually rise when people actually admit this to themselves, and this bubble is going to continue to grow until something pricks it. And the Fed is saying it's not going to be them, so it's going to be something else, and that might be the subprime auto market, might be where that occurs. So till next time, thanks.